Hey guys, it's Chris Mincolla with the Mincolla Group over at West USA Realty, and I am going to give you some great information today on what's going on in the housing market. There's some big news going on. There's a lot of news we can't get to it all, but we're definitely going to talk about some of the big headlines. And when you got to understand when we come through holiday season, especially the biggest holiday season of the year, all the metrics are going to be all messed up. So I'll get into that a little bit too. You really got to take it with a grain of salt on what's happening as far as sales and inventory and stuff. A lot of people go off the market. A lot of people, aren't shopping for homes. You do have serious buyers out there during the holiday season if they are out there looking, but you want to make sure that you realize that the numbers we're going to go over today, as far as supply and demand and things like that, are affected by the holiday, obviously, very much with Christmas and New Year's. So I'll be getting into more of that stuff in the granular next week, but let's jump right into some of the big headlines because there is a lot going on. So first thing is we want to look at the jobs numbers. We already know the inflation rate has definitely come down, not as low as everybody wants it. As far as the rear view mirror inflationary data, meaning that usually the Fed's kind of behind the curve, and we have a lot of the information that we're looking at that you see in the headlines is also rear view mirror. So we're going to be talking about more than now today also, but labor over inflation as far as interest rates, mortgage interest rates are concerned, and the Fed rate, which are not a one for one, but it does affect the 10-year Treasury, which affects our mortgage rate. So the labor market's a big component when it comes to housing because obviously mortgage rates are a big thing. So 2025 was the worst year for hiring since 2020. Earlier in the year, I talked about there's an economic conference, annual conference that happens every year. Over 90% of the we talked about this a couple months ago. Over 90% of the economists there said the big hold up with jobs, the big hold up with the economy in general, um, is yeah, there is some of the tariff craziness going on as far as what people were worried about that never really materialized. Even Jerome Powell said as much. He was actually surprised by the fact, that the tariffs didn't cause as much of an issue in reality as once feared. But we see that the labor is a big component. And one of the things that the economists talked about at that annual meeting, I shared this with you, was that the biggest thing holding up hiring, biggest thing holding up growth with businesses because businesses need capital and we run on a debt society, and that is the Fed's fund rate because it costs so much more when those rates are elevated, that Fed rate is elevated to borrow money. So they have less to put into production, less to put into growth and hiring and wages and things like that. So I just wanted to make sure we revisited that really quick before we jump into this, but for context. But we saw the worst year for hiring since 2020. December jobs report shows the U.S. added 50,000 jobs last month, a mixed report capping off a difficult year for the labor market. Okay, so we had and this is kind of right now has become the new norm without having the market juiced by a bunch of capital like we had over the last few years. But the stock market obviously is hitting all-time highs over and over and over again. Yes, a lot of that may have to do with AI, but it also has to do with a lot of incoming investment into the United States and on the front end of a CapEx boom that's coming. And we're going to see a lot of that materialize this year. Also, with a lot of the tax cuts that are going in, I think people are going to be pleasantly surprised with their taxes this year. Nobody wants taxes. I wish they would get rid of property tax, income tax, all the things, the capital gains tax. That would be one way of getting the, ball rolling with the housing market for sure. And a lot of states are even looking at property taxes and stuff. So those are all good things to definitely look at. But You know, we see with last year, the labor market just added jobs at an average pace of 48,000 jobs per month after revisions. Okay. And then the unemployment rate was thought it was going to be, they thought it was going to be actually, so a little good news, bad news. They thought the unemployment rate was going to be about, I think 4.5 was the projection, and it came in at 4.4. So, um, some good and bad news there on the jobs market. But today, um, we'll take a look, the 10-year treasury on that and the heels of something else that was just announced. Why don't we just jump right into it here? That was that President Trump announced something that definitely can help the housing market. Biden ignored the housing market and instead was immersed with high crime, open borders, runaway inflation, the Afghanistan disaster, and a military that left in chaos and confusion. Everything was broken, but I, as president of the United States, have already fixed it. Now I'm giving special attention to the housing market. Good. Because I chose not to sell Fannie and Freddie Mac in my first term, a truly great decision, and against the advice of the experts, it is now worth many times that amount, an absolute fortune, and has $200 billion in cash. Because of this, I'm instructing my representatives to buy $200 billion in mortgage bonds. This will drive mortgage rates down, monthly payments down, and make the cost of owning a home more affordable. It is one of my many steps in restoring affordability, something the Biden administration absolutely destroyed. We are bringing back the American dream that was destroyed by the last administration. Make America great again. Okay, so whether you are a Trump fan or not, I think this is actually a very good thing because there is a surplus there, and it's not about like printing money and creating more inflation to do this. um, Also, on a side note, HUD also has a 2% statutory uh, amount that they're supposed to keep in reserves in case something were to happen with their government backed loans, and that has to do with um, things like, can be related to like mortgage insurance. So if you default on your loan, there's mortgage insurance unless you put 20% down, so you don't have mortgage insurance, or you pay that down over time. But with government type loans like FHA, you have this mortgage insurance on there. And in a nutshell, without getting into all the weeds of the different types of loans, that's another aspect that could come into play where we could see those fees come down on mortgage insurance. That's just another thing that's being talked about. Also, we've talked about the SLRs before, the amount of money that banks have to have on reserve since the great financial crisis. So there's a lot of things in the works. Every little bit helps for sure. But we saw a big run on the 10-year treasury, which kind of goes hand in hand with mortgage rates. Basically, in a nutshell, what happened was we saw at one point today the drop in the 30-year mortgage rate. We dropped about 22 basis points. So it was a big deal. It dropped actually to 5.9 average across the country mortgage rate on Mortgage News Daily. It ended up right about here. So this basically puts the mortgage spread almost where it should be. We're still about 20 to 30 basis points off where we'd like to see it, meaning the spread between the 10-year treasury and the 30-year fixed. There's usually about a 1.65 to 1.85 difference between the 10-year treasury and the 30-year fixed mortgage rate. So right now, those spreads have gotten better. Probably more based on the news from President Trump than the labor market data. Okay. Because usually, if the labor market data has a higher employment rate, which it came in lower than expected, we would have seen a run on the market there too. based on that as another data point. But that really didn't happen. Weak jobs numbers, but we've had weak jobs numbers for quite some time. We even saw all the revisions back earlier in the year from the previous year, where there was over 1 million jobs that didn't really exist. So this is a big deal. Now, I can tell you right now, our mortgage broker actually this week put out a rate sheet before this happened, and these are their rates. So you can get lower rates right now. I think, I know our lender is going to be without buying down rates or doing rate buy downs or arms or anything, just out of the box. If you have good credit, I think we're going to be in the fours very soon. Now, this solution and that money reserve is something more so to think of it this way. Think of it as a backstop to the 10-year treasury going up or mortgage rates going up to a higher level by that money being there. So it'll keep the spreads kind of where they should be or where we want to see them. It'll get them there. And obviously, this is just the first day. So some of that money's already actually been spent there. So we'll have to see how this actually shakes out. We'll have to see if they come out with the SLRs, so the banks don't have to have as much or at all money on reserve. That could also bring the rate down a little bit more. And then, of course, we know Jerome Powell's reign of terror will be done in May. We've got another Fed governor leaving this month. We've got a Fed meeting at the end of the month. So it's all going to be very interesting. Right now the current Fed is saying one rate cut for the year. I think you're going to see more than that by the time once Jerome Powell is finished. So we'll keep an eye on that. But right now, guys, you can get these lower rates. So when you're hearing that stuff nationally, that's just a national average. And usually mortgage brokers, they have 100 lenders they can go to. They can shop the best rates. They're usually going to offer less in pricing for the overall APR and all that. So it's, definitely a way to go. And we could definitely connect you into that world so that you're saving thousands of dollars on your home loan and your monthly payment. So the other thing I wanted to mention that President Trump brought up, because he's coming out with a lot of new stuff here to help the housing market, is the idea that we're going to get rid of institutional, commercial, industrial size investment buyers. Okay, now here's the thing. Number one, you hear BlackRock's buying all the houses. Okay, first of all, BlackRock isn't buying the houses, it's Blackstone. Okay. You also have other institutional investment buyers like, Invitation Homes. There's a bunch of them out there, but it's Blackstone, not BlackRock. Okay. But more importantly, the real numbers on this are actually, let me see if, uh, let me get back to my screen here. Where am I here? Okay, let me share this. Let me make sure I'm actually sharing this with you. Okay, there we go. Mom and pop landlords are by far the largest owner of single family rentals, according to batch data. There's other data points, and this is from Resi Club. There's what basically in a nutshell, what it comes down to is the institutional buyers. It's basically right around, let's say, less than 1%. Some may have it at 1% or just over 1%. In the grand scheme, in other words, it's not really that many homes. Every little bit helps. Okay. Every little bit helps. Especially if it's you getting bought, in a competitive situation from this. But since the great financial crisis, we had all these homes on the market, and then you had all these, institutional buyers come in. But it's really a very, very low percentage, not to get too granular into the numbers, but in total, 89.6% of single family rentals are owned by landlords who hold between 1 and 5 properties. Okay. So I know there's a lot of clickbait out there. I get it. I know most people aren't tracking this stuff like we do every week, but hey, you know, uh, this is where we are. This is the reality of that situation. So is it really going to move the needle a lot? No. Every little bit helps. Yes. Some areas, areas of the country may have a little bit more than others. I think I heard a statistic. In Atlanta, there may be like 4% of homes are owned by institutional buyers. Even that is still a very low percentage, if that's even true. But overall, it's very very small amount of homes by companies like Blackstone. Okay, so anyway, just wanted to set the record straight on that so we don't have any misinformation there. Looking at the overall picture of the housing market in the United States, we talked about the 10-year Treasury, the mortgage purchase application index. We can see that we had purchase application data was up over 2024, obviously, looking at this graph. Obviously, in November, December, you had a drop off. Why? Holidays, okay, just like we talked about before, okay. But overall, we saw an uptick in pending sales and in loan application data. So that gives us kind of a window, and some of those people are sellers, yes. But that gives us kind of an idea of are things going in the right direction, looking out 30 to 90 days, because it may take a little bit of time to get properties under contract and such. Um, but right now the national single family inventory, um, is up over the last several years, which helps to stabilize prices a bit. Okay, but builders are not going to overbuild. You may have at any given year or time, 110, 130,000 single family new builds being put up. That's actually the real new fresh inventory, because most sellers are buyers. Typically 20 to 30% of buyers are going to be investors. Most of them, like we talked about, are mom pop, smaller investors between 1 and 5 homes, that sort of thing. Now they're going to come out with metrics on that whole thing with the institutional buyer thing. So how many homes does it really indicate that you're an institutional buyer, whether it's 100, 200, 1,000. We'll have to wait and see what that's going to break down to be. But in any case, the national single family inventory, uh, at the end of December, put us at 735,000 homes for sale. If you count dirt, um, and things in the works that haven't been finished or permitted yet completely, and all that sort of thing. Which, by the way, I want to tell you this: if you want affordability, the biggest thing you could do for affordability are, like I said, uh, you know, get insurance prices down. Uh, you could get rid of property taxes or reduce property taxes, capital gains taxes, increase inventory, which builders are not going to do. They're not the March of Dimes. Resale homes, again, remember 70 to 80% of them are also buying something. So that kind of cancels that out. So you have to give some sort of incentives to the builders, which the president already did this past week with some of the tariff stuff that was coming on board. And basically, he reduced the tariffs for some of the things like, furniture, wood, cabinets, things like that are going to be shaken out for remodeling, but also builders. Okay. Appliances, all that sort of stuff. So we've seen some of that take place too by the government, but there's only so much the federal government can do. So my point is, if you really, really, really want to get things going in your local market, the best thing to do is talk to your local government officials, because what it comes down to is more inventory. So we want, more incentives for home builders to build, to keep prices at a stable range, more options for buyers. We want, to get a better, more up to date permitting process. Sorry, guys. Permitting costs and process, that can really hinder the builders in building more homes, because really, in reality, those lumber costs and all that, it really only makes up about 7% of what it costs a builder to build a home. So the bigger issue is speed to build, as far as permitting costs, and all those sorts of things associated with it. So all the regulations can come up to 25% of the building costs for a builder. And I know nobody's going to cry for builders, but if you want more inventory, that is really what's going to move the needle. Okay. And some of those other costs around building, and the costs in your monthly payment, like insurance and taxes and those regulations. Okay. So there's only going to be really so much that the federal government can do, in other words. So, but obviously a big component of it's going to be the interest rates, and the regulations that they can control. Okay. So hopefully that helps a little bit on understanding that a little bit better. Um, Now, the inventory picture. Okay, we talked about that. Looking at the um, jobless claims, we talked about that. The national single family new listings, obviously, at the end of the year, they're going to be down a little bit. They were up earlier in the year. We saw a little bit of a increase going into um, a point where we got towards the end of the year, and there was a little bit of an increase there. We saw an increase once summer hit, because we saw interest rates going down. Okay, so all those things obviously are going to affect the new listings. Price reductions. Also, guys, if you're a home buyer, you're thinking about buying, you want to be ahead of the game. And if you're a seller, okay. So if you're selling and buying, you want to get ahead of it now, and you want to get where you want to be and get it done before the rates go too far down. And now you're going with the herd, because when you're going with the herd, you're going to be in competition with the other people. You're going to be paying more. You can always refinance later. We know we're in a rate reduction cycle. We know they're going to do everything to get rates down, costs down, regulation down, all those sorts of things from the federal government level. So, in other words, if you want to, the people who made out, during the whole COVID thing, were the people who bought early on. In other words, and then their value went up after everybody jumped into the market, right? It's kind of like, do I want to go to Disney in September or December? Do I want to go December 28th, when everybody's off from work, and, with the long lines and everything, or do I want to go in September, after Labor Day, when the lines are going to be, a lot shorter? Are you going to want to go with the herd or not? It's kind of like Warren Buffett says, you do these things, in the markets when other people aren't, and those are the people who win. Okay. So, it's just a matter of, I know, timing for a lot of people with school and everything too. I get that, but just a word to the wise, to get ahead of this, because we will see rates come down, and then we're going to see, it's not going to be overnight. It takes time for everybody to kind of catch up and realize what's happening, but we're going to see more affordability, and then we're going to see more people jump in the market. For every 1% or 100 basis point cut on rates, you've got 5 million more people who can, not that will, but that can afford to buy a home, or the home they want. Okay. So just something to think about. Percent of properties with recent price reductions. We saw that actually come down towards the end of the year, which makes sense, because people usually either take their home off the market a lot of times, if they haven't already sold, or they're just kind of sitting tight. So makes sense. So we kind of see that natural seasonal curve. Price cut percentage, though, overall was up 37.6% last year. And a lot of that, um, came and it was elevated up until we got towards, a point where people were getting used to these lower rates. And then you got into the new year. So we'll kind of have to wait and see what happens in the new year, and where things end up. Total pending um, total pending home sales uh, dropped off again towards the end of the year. Okay, but that's to be expected. And the spreads between the 10-year and the 30-year, the 10-year Treasury and the 30-year mortgage rate, 30-year mortgage, definitely have been getting better. Okay, so once we hit that 2% mark right in there, we start getting right back into where we want to see it between the 10-year Treasury and the 30-year mortgage rate. Okay, so one other thing I wanted to point out was why revisions are important. Last month's cycle showed a cycle higher in labor here in the building and construction, but after revision, there's a clear trend lower. Nothing big, just the trend, but lower. Okay, so very little, but a little trend lower. So, all employees, residential, building, and construction, we watch that because when manufacturing unemployment and we see unemployment in construction happen, that kind of always, if it goes up enough, long enough, leads to recession. Okay. Because, manufacturing and housing just touch so many sectors of the economy, um, you know, that it's just amazing. When you think about everything that goes into everybody that's involved in buying a house, and then when you buy the house, all the things you buy to put in the house and all the services you need to run the house, it touches a lot of different sectors of the economy. So definitely an important point there. So one of the other things, since before we get into this, is I wanted to show you this Trueflation. um, Definitely is going to be lower than what we see on TV for inflation. They, again, you can go and look at their website. I track this because it's more data points than what we actually see the inflation rate in different, shown different ways of CPI or PCE, touches more data points, and it's more of what's happening right now, not rear view mirror looking. And the reason why this is so low, as Jerome Powell pointed out, is that he is finally starting to see, even though it's been happening for literally 2 years, that the shelter costs, okay, and rents have gone down, which is how they track that. um, Owner equivalence rent, what they call and survey people, which is kind of a ridiculous way to do it, which you talked about before. But this is what we're seeing in the now inflation from Trueflation that Jerome Powell is finally getting caught up on when he had the last one or two press conferences. So he's way behind. We should be, as I heard Scott Bessent, Treasury Secretary, talk about yesterday at a conference he did. He said we should be more at a neutral policy, not a restrictive policy like we are right now on the Fed rate, which would mean more between 2.5 to 3.25 percent on the Fed fund rate. And right now we're running at like 3.5 to 3.75. So we're still way behind, and they're slow and old. Jerome Powell is very slow and old, and very political. We've talked about that before too, and I can prove it to you when we looked at the whole thing back in the day of it's transitory, inflation's transitory. Remember all that? Well, it was transitory up until he was rehired as Fed chair by the last administration. And then what happened? Literally 8 days later, he said, yes, inflation's a problem. And he raised, the Fed's fund rate, super high, one of the record high interest rate hikes and series of hikes that we've seen in a very long time. So he secured his seat, and then he went the other way 8 days later. Uh, and then we saw before the election last, 2 years ago now, back in 2024, right before the election, which they normally don't do, he lowered interest rates 50 basis points when none of the indicators would show anything like we've seen over the last year to do that. So again, just a couple of points there on how political the Fed has become. And that's unfortunate because they're supposed to be, neutral in that sort of world of the economics. And their dual mandate is, full labor, uh, participation, and tracking the inflation rate and making sure the inflation rate is at 2% is their goal. Which comes from actually an idea comes from another country that nobody's ever heard of. Some guy in another country that nobody's ever heard of. And I kind of like what Scott Bessa said recently is that your inflation target should be more of a range, so 2.5 to 3.5 or something of that nature. So I think we're going to see a big restructuring at the Fed too. You're going to see a lot of things this year happening. I think one of them is going to be a restructuring at the Fed, restructuring of a lot of things, models, all that sort of thing when we get our new Fed chair, which hopefully I think we're going to see by the end of this month. It's down to about four different people. So we'll see how that goes. All right. Um, so rounding out December, here were the numbers. Total sales in December were up 6,250 total sales. Total active was down, for December. That makes sense. But seeing the sales up, that's a good thing month over month. That's actually very surprising. So that's actually a good indicator going into the new year. I think the lower rates have a big thing to do with that. Obviously, we've seen that kind of track since summer and fall. Um, New listings, and just with the Fed not doing anything this year with the lower rates, by the way, it's all been the mortgage spreads between the 10-year Treasury and the uh, the 10-year Treasury and the 30-year mortgage rate. We've seen the spreads get better even without the Fed rate reduction that we should see in forward guidance and forward messaging, Fed Powell, that we should see from Fed Chairman Powell that we didn't really see and get. He started to come around at the last meeting a little bit, with saying, "Oh, I see, yeah, shelter costs are catching up now," and that sort of thing. And I think we're kind of through the tariff thing, and so he's very slow and old. But new listings were down in December. Makes sense seasonally. Pending contracts down, makes sense during December. Median sales price month over month, 450,000. Uh, that is up a little bit from last year, but month over month it stayed flat. This is in the Phoenix area, by the way. Average sales price was 609,000. That's up 3.65% month over month, and the average days on market was up 3 days at 87 days on market. Again, during December, higher number definitely makes sense. Now, a month supply, usually historically, anything below 4 months supply, okay, anything below a 4 month supply is traditionally a seller's market. In this case, it's almost 3.5%. So, uh, you know, I would say we're in a very slight advantage to sellers, maybe in certain areas, but nothing crazy. Okay. And stuff is sitting longer. So I think towards the end of the year, we've seen that, but that's normal. Median new list price was down a hair in the month of December. Again, makes sense. End of the year. Median new list price, 459,000. The average new list price was 600. So you had median, now average new list price, 682,118, down 3.5% month over month. Again, into the holiday season makes sense. So nothing crazy happening there. Although again, the total sales being up month over month, that means you got more buyers out there, guys. That means you got more buyers out there. that came in November, okay, and maybe tail end of October. But the pending contracts did go down, but it's December, okay? So again, totally makes sense, okay, for that pending side. Now, for inventory, seasonal active listings, again, you got to take this with a grain of salt, but we had actually higher inventory, stuff's just sitting longer, okay? We had an increase in inventory, um, this year in the greater Phoenix area of about 35%. So we see high inventory, for overall for the year. Again, not like not like a great financial crisis. I mean, we during right now we were sitting at like what 22,000 or so. Um, During the crash in the Phoenix area, we had like 58,000. So you would have to really more than double that to get to where we were during the crash. And again, those people were not just sellers, they were not buyers because they were losing their homes. Monthly active listings uh, down for December. Okay, totally makes sense. All right. But we saw the supply definitely go up this year. Okay. So going into the demand side of things, uh, we saw that, in December, it was pretty strong for looking at year over year. Okay. Again, year over year here, we were up for supply. Year over year here, we're up for demand. Okay. Again, 2020, 2021, that was insane. But we see that demand was up over last year, the year before, and the year before. Okay. Um, but the current demand right now is definitely lower than normal with the amount of supply that we have, okay? Because we had that increase in supply more than demand. And then we have the absorption rate, which puts us, according to this metric here, in a buyer's market because stuff was just sitting longer, okay? Now, if you go back to 2021, 2020, look at that. Look at that absorption rate, okay, in the month supply. So definitely pretty close on the absorption rate, maybe a little bit higher than last year, um, lower than 2023, um, a little lower than 2022. So, we definitely need some help there with getting properties to sell quicker. But keep in mind, again, if you're under a 4 month supply, you are definitely in that technically, historically in the seller's market, but we're so used to stuff selling in 2 weeks, right? So for a property to be on the market 60, 80, even 90 days, it's kind of a normal market, guys. It's kind of a normal to balance type market. The absorption rate, again, in December dropped off a little bit, to be expected. So uh, nothing really crazy happening there, guys. So that's all I've got for you this week. Oh, I did want to share this with you really quick. Okay, where'd it go here? Oh, tax deduction. Since we're going into the tax season, tax deduction for homeowners. Don't forget, if you are a homeowner or buyer, these are the advantages of owning a home as far as tax is concerned: mortgage interest, property tax deduction, home office deduction, energy efficient tax credits, HOA fees for tax credits, home expenses, points paid on a mortgage, and medical home improvements if you have any of those. So uh, definitely some things to keep in mind for the tax season coming up. So I hope everybody had a great holiday season. We're into a new year. We'll keep you updated every week as things come along. We'll see all of the things that the federal government's trying to do, but really it comes down to your local area. And I would love to see, again, those property taxes are a big thing. Capital gains taxes. The capital gains tax, that's something that could be done quickly. The same thing with the mortgage insurance. I think the buying of the mortgage bonds, that's going to be a good thing. It's more of a, hey, let's keep the spreads in check so mortgage rates don't go higher. So I think we're going to see steady lower rates this year. I think, for the national average, I think we're definitely going to be in the fives this year, pretty much all year, if not lower, but I think you'll see mid to high fives all year as far as the national at the very minimum. I Again, if you go with a mortgage broker, I think you're going to be in the fours very soon. So reach out to us to that if you have any questions at all about buying or selling your property and the best way to go about it so you save money. For us, it's not only us, but we have a system we use to make sure your property gets sold, proven track record. Uh, West USA Realty is the number one, according to Forbes and uh, hundreds of metrics. We've been voted number one company and brokerage in the country. So in the Phoenix area, we're one of the biggest companies, brokerages that get homes sold. Again, a proven track record that you can trust and a proven system that gets the job done for you. If you have any questions at all, feel free to reach out. We'll see you guys next time.